Larry, welcome. It's good to have you with us, and thanks for sharing part of your Tuesday morning. I wanted to talk about, first and foremost, energy. Is kind of a tough day for the crude bulls yesterday with the indices lower. The WTI broke below 39. I guess I'm wondering, where does this put the prospect for a bullish scenario to play out for crude over the next month or so, or as we head into the end of the year? It does seem like it's got the weight of the world on its shoulders right now.
That's a great way to put it, weight of the world on its shoulders. And yeah, there's been a lot of micro themes affecting WTI, especially also Brent. Have to say that the market's been really choppy, but full of surprises, especially with Libya coming on board and forcing a lot of production. But that said, I almost think the market's on hold at least for another week or two. It's made an extreme move. There's been a lot of activity, and I think there's been a lot of position squaring when you have the multiple effects of the election next week. You have renewed COVID fears, not to mention Libya, now Russia, the US dollar. So there's so much. It's almost becoming a benchmark of benchmarks. And I don't think I would have said that even a month ago. For me, it's always been the dollar and treasuries. But WTI has been a really good proxy for the health for the market and worth watching.
Yeah, I want to pull up this chart here because oftentimes we do, Larry, look at crude oil relative to the ES. And, well, here you can see crude's kind of been struggling for a little bit after topping out here right up around that $43 level back in the end of August. It's been struggling to get back up and through that level and now starting to roll over. Now holding up above key lows that we saw during the beginning of September. But as I mentioned here earlier, we're nearing those levels. Now, you also mentioned in your notes how we're seeing, well, one of the bearish factors for energy prices is weak U.S. gasoline demand, and ultimately we're talking about some of the economic data here in the U.S. as well.
Yeah, and that matters again because gasoline demand actually has been steady over the past 3 to 6 months, all things considered. And so people are, traders especially, trying to look beneath the surface and say, is this consumption data? Is this a one-off thing, or is this a trend that we're seeing that maybe we're fooling ourselves and really are looking forward or anticipating a double dip or a back down in the economy? And many times WTI gas consumption especially tends to be the benchmark or maybe the bellwether of what's going to happen going forward. So I don't think like one data point makes a trend, and I know that you agree with that as well, but it's worth noting. And I think, last Wednesday, I think a week ago Wednesday, when WTI fell 4%, I think that just renewed all the fears, and the data seems to matter again in the last month. It just seems like the data took a back seat to headlines.
Okay, that's crude, that's RBOB. We just looked at both of them together, or a minute ago we looked at the ES relative to crude. We know that these products track each other very closely, but it's interesting because I've been looking at natural gas as well, and that product is telling a little bit of a different story. Oftentimes we tie the bid in natural gas back to China demand, first and foremost, and then we can ultimately kind of tie it into U.S.-China relations and that whole discussion as well. But talk to us about what you're seeing in terms of natural gas, because it looks like you have your eye on it as well. Production may be shuttered if tropical storm continue to impact. Well, in this case, it's potentially the north, moves into the north of the Gulf of Mexico. But ultimately, what are you seeing there? I mean, it's been tropical storms. It's been increased demand from China. But also, we've been watching inventories, which, while still seeing builds, they've started to decline from some of the upper levels that we've seen. I think last week it was something like 56 or in the mid 50s now, down from those 80s and those upper 70s billion cubic feet weekly builds we had been seeing. Seasonal, I'd imagine, but also this bid is related to, what would you say, Larry?
It's been resilient when you consider the past 5 days relative to the energy complex. I think it's only off maybe 1% when you include today's pre-morning trade. Really it's fought against a lot of barriers. And right now, weather, renewed weather effects, colder weather in the Midwest, as we're witnessing right now, even in the East Coast. But really the bright spot, what's really held or anchored natural gas in place is like the surprise jump in export demand from around the world. And so that has really helped, keep natural gas in check. People don't realize that it has suffered greatly, especially mid to late summer. Even when you look to the forward contracts, and right now, yeah, it's off today a little bit, but it's only off 1%. Given the macro environment we're in, given the overproduction, the rig counts that people continue to talk about, export demand actually has really saved the day for natural gas, and I'm very positive on it going forward.
Larry, can you talk to us a little bit about, in the current environment, we've been talking about how we have a lot on the plate for traders to digest, to say the least, whether you're an energies, a more focused type trader, or whether you're looking at the indices, the currencies. I mean, this week, central bank activity started the week with volatility in the S&Ps. There's a lot going on, to say the least. How closely do you think traders are actually watching inventories with all the focus on demand, corona numbers, stimulus measures? I mean, are inventories kind of taking a little bit of a backseat role, assuming they don't come in completely above or below the mark? I mean, ultimately, they're just sort of, it seems like they're not a major focal point, I guess, is my point.
Yeah, no, you're right. They're not. I mean, you'll get that knee-jerk reaction. And of course, if the number is an outlier, as you mentioned, then that will change the fundamentals of trading. But people are so much more concerned and pondering the year end. Like, what's going to happen here? We have the Senate on pre-election leave right now.
Yeah.
The stimulus measures, completely an outlier. Continually hear news of COVID renewing itself in ways that might force more lockdowns, more restrictions. And so I think that, along with the election and the unknowns of the election, really what's keying on the market right now. And data points, no matter what they are, seem to take a back seat.
Okay, so we've got colder sooner, providing a little bit of a longer-term bid for natural gas. Certainly that snow here in Chicago yesterday was a bit of a disappointment to see. It didn't make me happy, that's for sure. I'm not a big fan of snow in October. In terms of some of the intraday volatility, you've got, well, potentially inventories and some of the other more closely watched, maybe more micro kind of catalysts here, as you just mentioned, if they come in off the mark. Talk to us a little bit about how this intraday versus bigger picture type approach towards trading crude products right now plays out. Because while we have seen some intraday volatility, Larry, if you're looking for that longer term trend type approach towards trading, you've been kind of, it's been lackluster, to say the least. We've seen that range bound more so approach. How are you approaching trading or looking at crude markets and in markets in general when you see this kind of consolidation and a lot less of a trend, well-defined trend type environment? What's your approach, and what would you recommend our viewers approach price activity such as this like?
Yeah, well, first, data to me does matter, and I'm not taking on the market in any stretch, and nobody should. But the fact of the matter is, looking at the consistent trend of what is happening, especially if you look at natural gas, the fact that export demand continues to at least rise from a pretty lofty level, as it were, given inventories, given everything else. I also look at like CFTC reports to see what managed money is doing, especially, think of treasuries, off topic a little bit, but you have 10 years at 80 basis points, 30s at 160, but both of them have record short open interest right now. So that matters to look at that data to see what managed money is doing. Managed money is not always right, it's not always wrong, but it does affect, or it can affect, a knee-jerk reaction in the market, especially when you look at treasuries having record shorts right now.
I like that. Talk to us. Is there impact on some of the upside movement we've been seeing in rates? I mean, could we tie it to some of the weakness we've seen recently in crude? We started the discussion here talking about how it just recently dipped down below 39. While rates came off a little bit yesterday, I think that was more kind of tied to the knee-jerk reaction that we were talking about also on some of the intraday volatility. But also, I mean, one could argue rates to the upside are a little bit of a concern for crude traders, I guess.
Yeah, no, it definitely is a concern for crude traders, at least in my mind. And I think that oftentimes is the least path to resistance, as it were. Like, nobody not many could imagine crude up, WTI up in the 50s or, even 55 perhaps. But it could easily get up there because that's where nobody expects it to go. And I think between now and the election, you're going to see a lot of knee jerks, a lot of intraday moves that perhaps don't make sense, people squaring positions. But that said, you have to look at markets of like where they were back in February. And, WTI being up in the 50s isn't out of the question in my mind, not in a week, but I think in a medium term trend. Just like treasuries, nobody would imagine that 10s could be at 80 basis points. They've been sitting at 60 for perhaps 6 months, but they are. And they were, over 1% in February, like 140, if my memory serves me correctly. So I think you have to look at it that way. Try to scrape away all the headlines and think, where were the markets in February? And I know that we're not necessarily going to go back to February's levels, but that might be some normalcy to give you some, maybe solace that, yeah, WTI could easily rally up there, especially because it's so hard for it to get up there. That seems to be the least path of resistance.